If you want to follow in the footsteps of famous investors, it can pay to replicate their investment ideas. Mohnish Pabrai, who has a net worth of over $100 million, has often been compared to American magnate Warren Buffett for his investment acumen and known as the Warren Buffett of India. When the rest of the world was looking for original ideas, Pabrai did the exact opposite. He openly but carefully and thoroughly replicated famous investor Warren Buffett and has amassed a fortune. He put in the winning bid of $650,100 in a charity auction to have lunch with billionaire Warren Buffett. Since then, Pabrai has become friends with both Buffett and his long-term business partner Charlie Munger. Pabrai was the son of a serial entrepreneur whose businesses failed repeatedly. He said that we didn't even have money to buy groceries tomorrow or pay the rent. He had a low self-esteem while he was in 3rd grade, and he was not performing well in school because he thought that he was a below-average person. This continued until 9th grade. In 9th grade, he attended a very good school with high-caliber students. One day, the school performed an IQ test in his class, and he ranked number 1 in his class. He asked the test giver how his test score was so high, but his grades were so low. Test giver said that he was brilliant, but he was not applying himself. He immediately took off after this realization. Every few months, his ranking improved. He ranked 3rd when he graduated high school and ranked number 1 when he graduated college. He grew up in India and went to the U.S. to study computer engineering at Clemson University in South Carolina. He enrolled in an investment class and performed very well that one of the professors advised him that he should major in finance instead of engineering and need to be in investing. But Pabrai's impression was that business was easier than engineering and found the class very easy. The reason Pabrai found his college finance classes simple was not because he was smarter than his classmates, but it was because his father was a small entrepreneur. After graduating from college, he worked with Tellabs between 1986 and 91. After working with Tellabs, he started his own successful IT consulting company in 1991, TransTech Inc., with about $70,000 from credit card debt and $30,000 from his 401k account. He bootstrapped the company to over $20 million in revenue when he sold the company in 2000 to Kurt Salmon Associates for $6 million. While running TransTech, he found out about Warren Buffett while reading a book, One Up on Wall Street by Peter Lynch. He hadn't heard of Buffett before this. But when he did, he was astonished to learn that the Oracle of Omaha had racked up investment returns of 31% annually over 44 years, and Pabrai read up several books on Buffett's methodology and religiously read every letter that Buffett had written to Berkshire's shareholders over the decades, and started following Buffett's investment principles to become a successful investor himself. As Pabrai started figuring out Buffett's approach, he understood that Buffett's stock-picking strategy emerged out of 3 key principles that Buffett learned from Benjamin Graham. The first principle is share price recognition. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. If you look at a stock chart of any company in the short term, you can see many hills and mountains, or you can see a valley or a trough. Stock prices can be volatile in the short term. They don't necessarily move in a straight line. However, as you zoom out and look at slightly long-term price patterns, you will get a better understanding of that company's stock, and the chart will move in the same manner as the company is performing in actual. Intrinsic value. Whenever you are looking to buy a stock, you should buy a stock only when it is selling far lower than your conservative estimate of its worth. The gap between its current price and the company's intrinsic value provides what Graham called margin of safety. In other words, when the market price of a security is significantly below one's estimation of its intrinsic value, the difference is the margin of safety. Because investors may set a margin of safety according to their own risk preferences, buying stocks with margin of safety allows an investment to be made with minimal downside risk. Understanding margin of safety. If a stock which is priced today at $100 can be either valued at $50 or $150 in the future, he also says that buying at $100 is also an unnecessary risk. He believes that if we can buy the stock below its intrinsic value that is at $50, the losses will substantially decrease in comparison to buying the stock at $100. Thus, the margin of safety would ensure him that his losses are minimal. Warren Buffett describes margin of safety concept using this example: when you build a bridge, you insist it can carry 30,000 pounds, but you only drive 10,000-pound trucks across it. And that same principle works in investing. Extreme patience. Between 1970 and 1972, when enthusiastic investors drove stock prices to most expensive levels, Buffett bought almost nothing. He says we don't get paid for activity, just for being right. As to how long we'll wait indefinitely. In 1973, when the stock market crashed, he acquired a majority stake in the Washington Post Company, which he held for 40 years. Today, Pabrai is the managing partner of the Pabrai Investment Funds, a group of hedge funds inspired by Buffett partnerships, which he founded in 1999 that invests in value-oriented stocks. The fund charges no management fee unless it gains at least 6% in a calendar year. Once the fund hits the 6% threshold, the fund charges a 25% incentive fee on profits. Pabrai has shifted his focus in recent years to giving money away rather than just compounding it. In 2007, he and his wife founded the Dakshana Foundation. It provides intensive coaching to gifted students from poor families to prepare them for the Indian Institute of Technology entrance exam, which is one of the elite universities. The main goal is to lift them out of poverty. Pabrai has come a long way since the days his parents couldn't afford groceries when he was a child.